Real estate investing can be quite complex, with so many companies offering investment products, all with different returns, collaterals, and risk. In this series of videos, we'll share how we break up real estate investing into 3 distinct stages, each with our own pros and cons, risks and rewards. Hi, this is Andrew, and in this video, I'll explain Stage 1 Create in detail. Let's get into it. Before we get started, I need to explain that I'm not a certified financial advisor. Neither is my business a certified FCA activity. This video is not advice, legal advice, nor financial advice, but for entertainment purposes only. Yes, this is how we operate our business, but it may not be suitable for you. All investments put your capital at risk. The value of your investments may go up as well as down. Past performance does not guarantee future performance. As always, I implore you to do your own research, DD due diligence, and get your own independent and legal advice. Stage 1. Create. There's no better place to start than at the beginning. Stage 1. Create. Before we even start to look for a suitable real estate site, we first need to choose our strategy. Are we doing residential, shops or retail? How about light industrial? Retirement villages? Hotels and apart hotels? L&L, large and luxury. There are so many to choose from. Before you start even looking for a site, you need to identify your strategy. For your reference, we focus on apart hotels and L&L. Now we need to find a site, one of the hardest things to do, so it's much easier said than done. Some of you may have heard of BMV, below market value. But we can't walk into an estate agent and ask for the 25% BMV properties. They aren't going to reply, "Certainly, here's our 25% BMV wall." No, we need to create the projects. So to do that, we need to create a pipeline of new properties to evaluate. We can get these from many sources: estate agents, sourcing agents, or our network. For your information, we find networking is the best. Once we identify a site may be suitable, now the work really starts. Is the site suitable for our strategy? First, we need to check the property title is clean. Any easements? Does it have planning permission? Do we need planning permission? Is the planning permission fit for purpose? PD, permitted development rights. Perhaps we can use the new classes D and E. Is the site now a valuable asset to the community? For example, is it the only shop for miles around? If so, there'll be some strong opposition if you want to knock it down. Is it in a business center, a place generating income? Converting employee centers or job sites that create revenues for the council into residential could receive some pushback from the local council. There are a lot of surprise costs underground. We need to look at the sites under the ground. Cables, water pipes, optic fibers. So is it suitable to build on it? Perhaps the site has issues such as knotweed, contamination, noise, flooding, etc., etc., etc. The first part is we need to really make sure the site itself is suitable for our strategy. Now that we know that the site is suitable for our strategy, do we have a tenant that's happy to rent it for a good price in that area? Yes, awesome. We can use the rent they're happy to pay to give us a budget for the project. Once we have a tenant, and monthly rent, we can employ the 5 protections methodology to protect our capital. Get an interest agreement from the tenant stating the conditions of their tenancy, monthly rent, term in years, and hopefully it'll be a 15-year FRI, which means a full repairing insurance lease. From the rent, we can calculate the GDV or DUV, which means the gross development value or the value of the completed project. If this is good, we can get a DIP from the Stage 3 commercial mortgage lender based on the GDV. Still good, we get detailed building costs. Still good, get a DIP from the Stage 2 development financier. Still good, we confirm our 4 profits. And to remind you, the 4 profits are refinance profit, net rental income, upselling to tenants, and selling when the market is up. If this all stacks up, after all this work, it's the lights are out and away we go. Oops, sorry, that's my secret. I'm a big F1 fan. Now we secure and acquire the site, preferably on a £1 option, delayed completion, or vendor finance. Or we may even need to buy it outright and pay the 20 to 30% down payment with finance. This may sound simple, but it's a lot of hard work, using a lot of expertise and working with a dedicated team of experts. If you're new to real estate investing, I hope you learn a lot about your strategy before you take action. There are so many resources online to learn from. For best results, I recommend you take a detailed course that may cost quite a few pounds, but the cost of those courses will be cheaper than the cost of the mistakes that you'll probably make. Stage 1 creation may sound easy, but there are many things to check at this stage. Stage 1 is mostly time-consuming, with some professional fees. The major cost here is time, with such a surprisingly low capital outlay. Dawn uses its own capital for Stage 1 only, and later leverages Stage 2 development finance and Stage 3 commercial mortgage when the projects are completed. Since we use so little of our own capital on Stage 1, our ROIs are quite spectacular. Thanks for the view, and if you found this useful, please like, share and subscribe. For more details on real estate investing, check out our other videos, links in the description. There are 3 other videos in this series detailing with stages 2 and 3 and an overview. Do you have any questions or tips for Stage 1? Please share in the comments.